Okay, ladies and gentlemen, chapter 29, now talking about the Federal Reserve and the tools that it has to control monetary policy or make monetary policy. In effect, we're talking here about how the Federal Reserve can increase or decrease the money supply to affect the interest rates. Here's the first tool that the Federal Reserve has. It's called open market operations. Open market operations is when the Federal Reserve, is buying or selling U.S. government savings bonds. In order to understand open market operations, you must first understand what a savings bond is. Remember that the federal government sometimes wants to spend money it doesn't bring in taxes. In order to do that, it needs to borrow. It needs to issue debt certificates, little pieces of paper that says, I promise to pay you back in a year, 5 years, 10 years, whatever the period of time is. If the Federal Reserve buys or sells U.S. government savings bonds, it can increase or decrease the money supply. Let's talk about how. So first, let's talk about when the Fed, the Federal Reserve, buys U.S. government savings bonds. When this happens, what I'm going to tell you is that it increases the money supply. Let's follow along as I explain this process. Let's say we have a banking institution. It is Bank of America. Over here we have Bank of America's liabilities, and over here we have its assets. Let's say Bank of America opened its doors today, and it saw that people were excited about this new bank, and they deposited $1 million into that bank. Bank of America immediately has $1 million in cash in its vaults that we would call reserves. Now remember what Bank of America is in the business of doing. They're in the business of making money, and they make money by giving out loans. But they're at the mercy of the Federal Reserve. The Federal Reserve creates the rules that Bank of America has to follow. Remember that Bank of America can't loan out $1 million. They have to keep some in the form of reserves. And usually the rate they have to keep is 10%. That's usually the reserve requirement. So let's just say here that Bank of America doesn't need to hold on to $1 million. They only need to hold on to $100,000. The rest they can give out in loans. And they can give it out to anybody. Me to buy a house, you to buy a car, you to go to school, businesses to get started or businesses to expand. They can give it to small governments, local governments, state governments, international governments, or they can give it to the United States government. Let's say the Bank of America decided that it was wise to lend to the U.S. government. They were going to buy U.S. bonds. And they were going to buy quite a few of them. They were going to buy 900,000 dollars worth of U.S. government savings bonds. Well, remember what we just did now. We just created a loan, and we're sending it to the United States government. They're going to buy something. They're going to obtain somebody's services. So that means that somebody's going to have income. And that person, when they spend their income, let me retrace my steps here. Because what I want to tell you is that when these people deposited $1 million worth of funds, that's $1 million worth of purchasing power that exists in our economy. But now that the Bank of America makes a choice to lend out $900,000, I've just increased the money supply by $900,000. I've created $900,000 worth of new purchasing power. That's what banks do. That's how they're so influential. They create money because money is just purchasing power. But what I'm trying to say here is that this process is never-ending. That the money that's spent by the U.S. government is going to be income by somebody else. They're going to put it back in a bank, and this process is going to start again, just with a smaller amount of money. We know that at the end of this whole process, we can have each dollar bill supporting a maximum of $10 worth of purchasing power. So we have $1 million that have been deposited in the bank. In this situation, with these rules, $10 million worth of purchasing power could be created or could be supported. But we're saying, how can the Federal Reserve increase or decrease that $10 million? Well, let's say the Fed wants to buy these bonds from Bank of America after they lent it to the United States government. Well, what would happen is that these guys in their portfolio would no longer have U.S. government savings bonds. They would have taken those bonds and given them to the Fed. The Fed, in exchange for those, would have given them $900,000 worth of new reserves. And remember now, these reserves are going to look a little different than these ones. This is mandatory. That's required. You have to hold on to $100,000. But now, this banking institution has $1 million worth of reserves relative to $1 million worth of deposits. They're at 100% reserve ratio. They only need to be at 10%. So now that I have $900,000 in cash, I can go ahead and make $900,000 worth of new loans. I can now add $900,000 to this purchasing power in this economy. And then that process continues again. It starts all over, just with a lower amount of money, $900,000. At the end of it, each dollar can be supporting $10 worth of purchasing power. It's just $900,000. So we could, if the Federal Reserve bought $900,000 worth of government bonds, increase the money supply by a full $9 million. We might ask, how in the world can the Fed do that? Where did they get the money to buy these U.S. government savings bonds from Bank of America? And the answer is quite simple. They just created it. Because the Federal Reserve is in the business of printing money. All they needed to do was change the bank account of these people. They just said, you have a couple extra zeros. You have 900,000 in your bank account. They just created it. To pay for it, the Fed just deposited new reserves in these commercial bank accounts. And with new reserves, they can make more loans that increases the money supply. This is their first and most often used tool of increasing the money supply. But they could work in the exact opposite fashion as well. They could look to sell U.S. government savings bonds that they own. And in doing so, they decrease the money supply. So it works in an opposite fashion here. We again have our liabilities and our assets, and let's just say we're working with a new bank. It's Chase. Chase, they got $1 million worth of deposits. And over here we have $1 million worth of reserves. But instead of holding on to $1 million, again, they loan it out. They loan it out to a variety of people. But they only loan out $100,000. So that meant they changed this number, and instead of holding on to only 10%, which is the rule, they're holding on to 20%. Well, they have $100,000 worth of excess reserves. What could they do with them? Well, this bank could buy U.S. government bonds from the Fed. In order to do that, they would have to have excess reserves, and they do. They can buy $100,000 worth of bonds. So now, instead of having currency as an asset, they have $100,000 worth of bonds. And now, instead of having $100,000 in reserves, or excuse me, 200, now they only have 100. They took $100,000 in reserves and sent them to the Fed. And what did the Fed do? The Fed just basically destroyed them. $100,000 worth of purchasing power has just gone over here and been evaporated. Those excess reserves aren't going to support any new loans. And remember that each dollar supports $10 worth of purchasing power. So when $100,000 worth of loans is going to, or excuse me, loans, not loans, $100,000 worth of currency is going to pay for the bonds that the Federal Reserve owned. That is 10 times 100,000, or $1 million worth of purchasing power that's being eliminated. So in effect, the money supply is going down. So this is showing you that the Fed's powers are not only to increase, but also to decrease the Federal Reserve, decrease the money supply. All they have to do is buy or sell U.S. government savings bonds. So to pay for them, commercial banks have to use their reserves. When the commercial banks are using their reserves to buy bonds from the the Federal Reserve, they have less to give out to you and me. Less loans to you and me means decreasing money supply. But that's not the only tool that the Federal has. That's just the most often used tool. The second tool is the discount rates. In order to understand the discount rate, you need to understand that banks borrow money in addition to lending money. And the first person they borrow from is the Fed. So the Federal Reserve lends to commercial banks like Bank of America and Chase and PNC and all these other ones. And when the Fed makes loans to banks, it charges interest. And that interest is called the discount rate. So again, what are we talking about here? We're talking about the Fed's ability to increase the money supply or decrease the money supply. How can the use of the discount rate increase or decrease the money supply? Well, we are just going to change their incentives. Remember that banks need reserves to make loans. Well, the Fed can give them more reserves by loaning them money. So, if the discount rate, is adjusted to make it more attractive to borrow from the Fed, then banks, like Bank of America, are going to borrow more. If they borrow more, they have more reserves. With more reserves, they can fund new loans. With more loans, that means we are creating purchasing power. So if we decrease the discount rate, which is the price of a loan from the Fed, we are going to increase the money supply. So decreasing the discount rate increases the money supply. But it could also work in the opposite fashion. So the less banks borrow, the less reserves they have for funding for new loans and decreasing the money supply. So if we wanted to do this, we would increase the discount rates. That's making it more expensive to borrow from the Fed. That means fewer people are going to do that. And when fewer people borrow from the Fed, that's fewer reserves. Fewer reserves mean fewer loans. Fewer loans means a smaller money supply. That's the second tool that the Fed has. The last tool that the Fed has is something called the reserve requirements. And if we remember, the reserve ratio is how much banks are holding reserves relative to their deposits. And it has an inverse relationship with the money multiplier. That's how much purchasing power could be supported by a single dollar in the banking system. Remember, what if we say we have to only hold a tenth of our deposits in the form of reserves? The money multiplier is quite big. It's 10. What happens though if it's a little bit bigger? What if we say you have to have 25% of your deposits in the form of reserves? Look what happens to the money multiplier. It shrinks considerably. And we can continue on indefinitely. You have to have 50% in the form of reserves relative to deposits. That means every dollar only supports $2 worth of purchasing power. And remember what purchasing power is. It's money. So, if we want to increase or decrease the supply of money, all we need to do is change the reserve requirements to get the banks to hold more or less reserves. So the Fed sets the reserve requirement, which regulates the minimum amount of money that banks must hold in reserves against their deposits. Reducing the reserve requirement is going to lower the reserve ratio. Banks are going to give out more money, and that's going to mean higher money multiplier, and then higher money supply. And it can obviously work in the opposite fashion. If we increase the reserve requirement, take it from 0.1, do away with that and say it's 0.5. The money supply is going to drastically shrink because banks are going to have to call in their loans, not be able to make new ones. And calling in your loans as opposed to making new ones means the money supply is shrinking, purchasing power is being reduced. So, I just said that the Federal Reserve has tools to control the money supply. But they're not perfect. They can't control everything. Here are some of the things that they can't control. There's two of them, really. It cannot control household actions. Earlier, I showed you a T-chart where a bank had liabilities and assets. And this was Bank of America, and it all started when people deposited $1 million in the bank. Well, what made them do this? Why didn't they just sit on $1 million? Why didn't they just sit on $250,000 or $500,000? I don't know. All we know is that if households choose to do this less, meaning hold more currency in their pocket, under their mattress, outside the banking system. That means there's less reserves for banks. And less reserves for banks means fewer loans, which means purchasing power isn't being created. The money supply is not increasing. So, if we said there's a situation where people, for whatever reason, decide to hold more currency, they're going to see, in this society, money supply falling. Because the Fed can't control this, they can't perfectly control the money supply. That's one complexity here. That's one problem that they face. The next thing they can't control is the actions of banks. So they can't control exactly what Bank of America and Chase and all these other people do. They can create incentives to alter behavior, but they cannot, determine it precisely. So let's say we had Chase, and Chase had $1 million in deposits, and they have $1 million in the form of reserves. Chase needs to make a choice with how much it wants to hold in reserves and where it wants to loan money and how much it wants to hold or loan money. The more money it loans out, the more purchasing power is created. So the maximum amount that they can loan in a system where we say it's 10% is I hold on to 100,000 and I make loans worth 900,000. This is going to create the maximum amount of purchasing power. But who's to say they did this? Who's to say that instead of, choosing to allocate their resources that way, they didn't go with $300,000 in reserves and $700,000 in loans? If banks are choosing to hold more in reserves, then they have to. That's going to shrink the money supply because there's not as much purchasing power being created. And the Fed cannot control the actions of banks, which is dealing or creating this second issue in controlling the money supply. But despite that, the Fed can compensate for household and bank behavior to retain fairly precise control of the money supply. If they want it to go up, it will go up. If they want it to go down, it will go down, believe me. They have that power. They just can't control it as precisely as they might want. Last two topics here. The second to last topic is something called bank runs. Bank runs were seen more in the past than they are today, and we'll explain why that is in just a second. But bank runs happen when people get rumors or hear things that the bank that I choose to deposit my money in has made poor choices. It has loaned out to the wrong people, people who aren't going to be paying it back. Back in the day, that used to cause real concern. People, often en masse when they heard a rumor, approached a bank and said, I want to withdraw everything that I deposited. Hopefully we know that that's going to create a real issue because we have what's called a fractional reserve system. Banks don't have enough reserves to pay off all depositors. Banks are therefore going to have to close their doors when this occurs. And this is terribly destructive. Because remember what a bank does. It allows you to go to college. It allows me to buy a home. It allows you to open a business or to expand your business. If banks are forced to close because, sometimes rumors get started that somebody's not going to be able to repay their loan and all their customers want to withdraw their funds as opposed to deposit them, that is going to ruin your college education because you're not going to be able to get the loan. It's going to ruin my future because I'm not going to be able to buy my house. It's going to ruin or destroy your business opportunity because you can't make it happen without a loan, and loans can't happen without these banks. These banks don't exist because they're all closed because of these bank runs. This happened during an era that this happened quite frequently from 1929 to 1933. The U.S. saw a wave of bank runs. 28% was the reduction in the money supply. That meant purchasing power was reduced by 28% because people lost faith in banks. They ran to them, wanted their deposits back. The bank didn't have the money to fulfill that, so that meant only the first in line got their funds. And then they shut their doors and no one could get loans. Business activity ground to a halt. Life was miserable in this period. Economists say that this didn't create the Great Depression, but it made this depression much, much, much more severe than it otherwise would have been. So what we've done is we said we want to avoid that future. We like banks. We want banks to be healthy, or at least we want people to perceive them as healthy, deposit money, so we create that purchasing power. You can buy a car, I can buy a home, you can go to school, you can start your business. So what we've done is we've created Federal Deposit Insurance. This is a program that says, so long as you have less than $100,000 in any one bank account, if that bank goes under, meaning it goes bankrupt, it closes its doors and says, sorry, we sold everything we have, we can't meet your deposits, we can't meet your demands. The federal government says, it's okay, we'll replace that full $100,000. This gives people peace of mind. This prevents bank runs. It prevents our banking system from having to hold in reserves almost everything that has been deposited, allows you to get a loan, and it has improved the banking system substantially. But there are little externalities which we could talk about at a later time. We don't have the time to discuss for now. We need to move on to our last topic, this thing called the federal funds market and the federal funds rate. Well, like I just described, banking is unpredictable. We have people depositing money and withdrawing money all the time, and in large quantities and in small quantities. There is no rhyme or reason. What we've said is the banking system has rules created by the Fed, and oftentimes it's 10%, meaning banks have to hold 10% relative to their deposits. But, like I just said, banking is unpredictable. Sometimes deposit a lot of money, sometimes people are withdrawing a lot of money. So sometimes banks who have loaned out pretty close to 10% might find themselves at, not 10, but at 7 or 8 or 9%. What happens when banks find themselves with 7, 8, or 9%, or even lower? What is forced to happen? Well, when this occurs, the Federal Reserve is going to fine you after 2 weeks' time if this persists. So people who have insufficient reserves need to obtain loans. And like I said, you can get a loan from the Federal Reserve, or you can borrow from another bank. And in the federal funds market, we have banks borrowing from other banks. We have banks who have insufficient resources borrowing from those who have excess resources. Maybe when the days close, a certain bank has 15% in excess reserve, who has 15% when they only needed 10%. They have 5% in excess reserves. Okay? So what the heck would you like to do with your excess reserves? Would you like to earn a little interest on it, or just have it sit here and earn nothing? We would say that banks who have excess reserves would like to lend to those who have insufficient reserves, but wouldn't do so for free and need to determine a price. The price that they pay is called the federal funds rate. Okay? The federal funds rate is going to be an important interest rate. Sorry. We're going to go right here, and we're going to see how it's determined. We have a downward sloping demand. This is banks who want to borrow from other banks to cover short-term shortfalls in their reserves. So maybe this is people, or this is definitely people, who have this insufficient reserves. And we have people who have excess reserves. And where supply and demand meet, we have what's called the federal funds rate. And this is an important interest rate because it's kind of a benchmark. Every other interest rate, a car loan, a home loan, U.S. government savings bonds, every interest rate is really pegged to a benchmark. This is the benchmark. So if the Federal Reserve is looking to do something, they're going to look to target this. They think they can increase or decrease the federal funds rate, which is going to move all interest rates up or down. Let's look at one policy that they have which influences the federal funds market. Let's say the Federal Reserve sells U.S. government bonds. Remember, that's them selling government bonds to commercial banks like J.P. Morgan Chase and Bank of America and PNC and all these others. Well, in order for people to buy from the Fed, in order for the Fed to sell to banks, They must have had excess reserves. Well, if the Fed is selling to these banks, these government bonds, that means those banks are using excess reserves to buy those debt certificates issued by the federal government. When that happens, what we find is the supply of funds here in the federal funds market is going down. When that happens, we have, a situation that we know as a shortage. Okay? This is how much that people have. This is how much people want at this price, because excess reserves are getting pulled away to another area. And as a result, we're going to have a new equilibrium, and the equilibrium is going to be higher. The federal funds rate is rising. And remember what I said, that's the benchmark interest rate. So now a student loan is going to go up in price. A car loan is going to go up in price. A home loan is going to go up in price. Every other interest rate which is pegged to it rises. That's what this graph shows you. This graph shows you the federal funds rate and all these other rates. And you can see they coincide with one another. So that is what the Federal Reserve is actually targeting. They're going to target here the federal funds market and the federal funds rate when they're looking to alter choices of people in the United States. That's how the Fed controls monetary policy. Here is your summary slide. Take a second to look at it. There are 3 points that are made. If you have any questions, we'll get to tackle them in class. Until then, that's all, folks. Please go and fill out those response forms because they give me much needed information that I can use to help you.